What is happening, crypto enthusiasts? Welcome back to Bitcoin Bulletin, your ultimate source for the pulse of the digital asset world. The market is absolutely electric, folks, and the pace of news is insane. We've got seismic shifts happening, critical indicators flashing, and major players making moves that could redefine the entire landscape. Are you ready to dive into the most crucial updates you need to know? You better be, because we're breaking down everything you need to stay ahead of the curve. First up, we're talking about the big money. Those massive Bitcoin ETFs that have been making waves, well, they're facing a critical test this week. We're diving deep into the numbers, exploring the massive inflows needed to avoid a record-breaking outflow and what it means for the price action. This is the institutional story you can't afford to miss. Then, we switch gears to a stark warning from a leading analyst. Could Bitcoin be staring down a massive correction? We're breaking down the signals, the liquidity concerns, and what the Federal Reserve's policies could mean for the future of BTC. This is a head-scratcher that could impact your portfolio. And that's not all. We've got whale activity sending shockwaves through the market, historical trends pointing to potential turbulence, and a look at how institutions are increasingly making Bitcoin a core part of their strategy. It's a jam-packed episode, so buckle up. Make sure you smash that like button, subscribe if you haven't already, and ring that notification bell so you never miss an update. The ETF tightrope walk. Can Bitcoin funds avoid a record downturn? This week, the spotlight is firmly on the US-listed Bitcoin exchange-traded funds, ETFs, which are facing a critical juncture. These innovative investment vehicles, launched in January 2024, have become a pivotal gateway for institutional and retail investors seeking exposure to cryptocurrency without the complexities of direct ownership. Cumulatively, they've attracted a staggering $53.9 billion in investor capital since their inception, fundamentally altering the accessibility of Bitcoin. However, the momentum has shifted dramatically this month. Data reveals that these funds have experienced a net outflow of $972 million, positioning them for their second-worst performance on record, surpassed only by the $3.56 billion outflow seen in February. A continued negative trend by the end of the week would shatter a 4-month streak of consistent inflows, signaling a significant cooling of investor appetite. Analysts are closely watching this slowdown, identifying it as a key factor contributing to Bitcoin's recent price stagnation. After reaching a historic peak of over $124,000 earlier this month, the price has retreated to just above $100,000. The implications of these ETF flows are profound. As noted by MatrixSport in their Chart of the Day, this month's outflows could rival February's peak during a period of significant market disruption. While seasonal headwinds might be temporary, they serve as a potent reminder that capital flows and cyclical patterns remain crucial drivers of asset performance. The firm advises caution, suggesting that while macroeconomic factors may eventually propel Bitcoin higher, the current environment demands a careful approach. Looking ahead, the consensus among many observers is that Bitcoin is poised for further gains, with projections suggesting a potential rise above $150,000. However, achieving such ambitious targets hinges on substantial capital injection into these ETFs. Marcus Thielen, founder of 10x Research, emphasizes that narrative alone isn't enough. Tangible capital flows are essential for price appreciation. To reach the $150,000 mark, Bitcoin would require an additional $173 billion in inflows by year-end, a figure that more than doubles the combined allocations from Bitcoin ETFs and major corporate holders like MicroStrategy since January. This highlights the immense capital requirements needed to sustain upward price momentum in the current market. Meanwhile, in a contrasting trend, Ether ETFs have shown remarkable resilience, registering a net inflow of $3.23 billion this month, extending their positive streak since April. This divergence underscores the varying investor sentiment across different digital assets. But what happens if these inflows don't materialize? Could a different set of market forces be at play, potentially leading to a much sharper downturn? Stay tuned as we break down the stark warning from a leading analyst about a potential Bitcoin crash driven by U.S. liquidity concerns. Fed liquidity drain sparks 65% Bitcoin crash warning. A prominent analyst from GLJ Research, Gordon Johnson, has issued a stark warning, predicting a potential 65% crash for Bitcoin. The core of his concern lies in the significant contraction of liquidity within the U.S. financial system, a factor he believes is directly linked to the cryptocurrency's vulnerability. Johnson points to the complete draining of the U.S. Federal Reserve's Overnight Reverse Repurchase Agreement, ONRRP, facility as a critical indicator, a condition not observed since the substantial surge in RRP usage back in 2021. This isn't a question of paper hands. The ONRRP is now fully drained, something we haven't seen since it surged in 2021, Johnson stated, emphasizing the severity of the current liquidity situation in light of Bitcoin's recent price volatility. Johnson's analysis draws a compelling parallel between the ebb and flow of U.S. liquidity and the performance of the broader market, citing a strong 79.4% correlation between total U.S. liquidity and the S&P 500's performance. He cautions that unless the Federal Reserve pivots from its current quantitative tightening, QT, policy back towards quantitative easing, QE, the market could experience a sharp liquidity contraction, reminiscent of the conditions seen in 2022. His data indicates a notable drop in overnight RRP usage, decreasing by approximately $1 trillion from a peak of $2.5 trillion in early 2023 to its current level of around $500 billion. This tightening of financial conditions historically correlates with reduced risk appetite and asset price declines. The analyst's projection is based on historical precedent, recalling that Bitcoin experienced a significant 65% decline during the liquidity tightening phase of 2022. Johnson suggests that current macroeconomic conditions, particularly the Fed's QT policy, could trigger a similar downturn. Bitcoin's price action has already begun to reflect investor apprehension. On August 25th, the cryptocurrency dipped below $109,000 following a substantial sale of $2.7 billion worth of BTC by a large holder, often referred to as a whale. At the time of this sell-off, Bitcoin was trading at $109,851.06, a noticeable drop from its recent highs, and its market dominance slipped to 57.9%. This price movement occurred amidst a broader cryptocurrency market downturn, which saw liquidations exceed $900 million in a 24-hour period, with long positions accounting for $818 million and over 203,687 traders facing liquidation. Major altcoins, including Ethereum, Solana, and Dogecoin, also experienced significant losses, dropping between 7% and 8% during the same timeframe. As U.S. financial liquidity continues to tighten and the Federal Reserve maintains its hawkish monetary stance, Johnson's forecast paints a concerning picture for the near-term prospects of digital assets, particularly Bitcoin, which has demonstrated a pronounced sensitivity to such macroeconomic shifts in the past. While liquidity concerns loom large, another significant factor is impacting Bitcoin's price: the movement of large holders, or whales. Could these massive transactions be signaling a broader shift in the market? And what does it mean for Bitcoin's price in the immediate future? Whale exodus and market fear. Bitcoin faces selling pressure. Bitcoin's price has recently dipped to $109,400, a 6-week low, amidst a significant sell-off orchestrated by a dormant whale who offloaded a staggering $11 billion worth of BTC. This massive transaction, with the majority of funds reportedly moved to Ether, ETH, via the decentralized exchange Hyperliquid, has injected a potent dose of bearish sentiment into the crypto market. On-chain data reveals a concerning trend. All Bitcoin wallet cohorts, from small holders to large ones, have entered a distribution phase. This synchronized selling activity, notably led by mid-sized holders, those possessing 10100 BTC, is raising serious questions about the sustainability of Bitcoin's current price levels and the potential for further declines. Despite the downward price pressure, the demand for Bitcoin futures has shown surprising resilience, reaching a notable high. Open interest in Bitcoin futures climbed to 762,700 BTC on Monday, marking a 13% increase over the preceding 2 weeks. This surge in futures activity, while indicating continued trader engagement, doesn't necessarily translate to optimism. The $85 billion in open interest reflects a balance between long and short positions, and the recent rapid price drop has led to significant liquidations, with $284 million in long positions being wiped out over a 2-day period. Adding to the prevailing fear, the Bitcoin options market shows put options trading at a 10% premium over call options. This premium indicates a heightened level of concern and a greater expectation of price declines among investors. Such sentiment is not unusual after sharp corrections, but the speed and scale of the recent sell-off, coupled with whale activity, are prompting a reevaluation of market dynamics and investor risk appetite. Adding another layer of complexity, historical data suggests that September is traditionally a weaker month for Bitcoin. Since 2017, Bitcoin has experienced an average decline of 21.7% during this period, often referred to as the ghost month, which this year spans from August 23 to September 21. The current price correction aligns with this historical pattern. Analysts are closely monitoring key support levels, warning that a sustained break below $105,000 could accelerate selling pressure, potentially pushing Bitcoin towards the $92,000.89,000 range. The absence of robust cost support between $100,000 and $90,000 increases the risk of a sharp sell-off, especially if recent buyers begin to capitulate under mounting pressure. Furthermore, the broader market context reveals signs of potential ETF fatigue, with net outflows from US-listed spot Bitcoin ETFs totaling $1.2 billion between August 15 and August 22. While some traders are betting on a rebound, the resumption of consistent ETF inflows and a broader recovery in investor confidence are crucial for any significant price appreciation. While whales moving their Bitcoin and historical September trends paint a cautious picture, there's another narrative emerging about Bitcoin's long-term role. How are major institutions integrating Bitcoin into their core strategies, and what does this growing adoption mean for its future? Bitcoin's portfolio power play. Institutions embrace BTC treasuries. In a significant shift in financial strategy, Bitcoin is increasingly being recognized not just as a speculative asset, but as a strategic treasury reserve. This evolution is being driven by a confluence of factors, including growing institutional adoption, evolving macroeconomic conditions, and a desire among corporations to diversify their holdings beyond traditional cash reserves. The narrative around Bitcoin as a potential hedge against inflation and currency devaluation is gaining traction, prompting more companies to explore its inclusion in their balance sheets. This trend is fundamentally reshaping how Bitcoin is perceived and integrated into mainstream financial portfolios, moving it from the fringes to a more central position. The institutional embrace of Bitcoin is multifaceted. Many companies are now actively acquiring and holding Bitcoin directly on their balance sheets, viewing it as a long-term store of value. This contrasts sharply with earlier phases where adoption was primarily driven by venture capital or speculative interest. The establishment of Bitcoin ETFs has further accelerated this trend, providing a regulated and accessible avenue for traditional financial players to gain exposure. These ETFs have not only democratized access, but have also lent a degree of legitimacy to Bitcoin as an asset class, encouraging more conservative investors and corporations to consider its potential benefits. The increasing number of companies adding Bitcoin to their treasuries signals a maturing market and a growing confidence in the cryptocurrency's long-term viability. Macroeconomic forces are also playing a crucial role in this adoption cycle. Periods of economic uncertainty, rising inflation, and geopolitical instability often lead investors and corporations to seek alternative assets that can preserve purchasing power. Bitcoin, with its finite supply and decentralized nature, is often cited as a potential solution to these concerns. As central banks globally grapple with managing inflation and economic growth, the appeal of assets outside the traditional financial system strengthens. This environment creates a fertile ground for Bitcoin adoption, as it offers a different risk-reward profile compared to traditional financial instruments. The ongoing debate about quantitative easing versus quantitative tightening and their impact on fiat currencies further bolsters the case for Bitcoin as a hedge. The implications of this institutional adoption for Bitcoin's role in portfolios are profound. It suggests a potential stabilization of its price, as large, long-term holders are less prone to short-term market fluctuations. Furthermore, it could lead to increased demand and liquidity, making Bitcoin a more integrated component of diversified investment strategies. As more companies adopt Bitcoin treasuries, it reinforces its position as a legitimate asset class, potentially attracting further capital and innovation. This strategic integration is not just about price appreciation, it's about Bitcoin's evolving function within the global financial architecture, solidifying its place as a key asset for the modern era. So, we've covered the critical ETF flows, the bearish warnings, the whale activity, and the rise of BTC treasuries. It's been a whirlwind of news. Now, let's quickly recap the biggest stories of the day and what you need to remember. All right, that's a wrap on today's essential updates. We saw Bitcoin ETFs facing potential record outflows, a stark warning of a potential 65% crash due to Fed liquidity changes, massive whale selling driving market fear, and institutions increasingly adopting Bitcoin as a treasury asset. Don't miss out on any of the action. Hit that like button, subscribe to Bitcoin Bulletin for your daily dose of crypto insights, ring the notification bell so you're always in the loop, drop a comment below with your thoughts, and follow us on all social platforms to stay connected. We'll see you next time.